All right, let's take a look at some, as the exercise here says, management accounting terminology or managerial accounting terminology. And we've been provided with 15 terms here, okay? And I decided to do this on paper because in an online view, it's very, very difficult. This is all of these answer choices here in a drop-down box, and it's very, very cumbersome to deal with this. So I'm basically going to be giving you the answers in this exercise, and that may not seem like it has a lot of value. But if we understand why the answer is what it is, well, then we can maybe that'll help us out when we get to some multiple choice questions on an exam. So this is certainly, as far as a kind of an introductory type chapter in managerial accounting. We could include a lot of other terms. I would probably even argue that some of these terms are not specific to managerial accounting. In fact, they are not. And also, I would say that we could probably do without some of these terms. So these are not the only terms that we're going to learn, but this is where we are going to start off today. So what we're to do is we're to start here with number one. The term is ethics, and then we're going to look down here and see if we can find the answer. And so I went ahead and worked through this in advance so that it wouldn't take me too long to get the answer. And so when we talk about ethics, they define it as this item right here, letter L, the propriety of taking some action. And so when we talk about the word propriety, what we're talking about is in some way conforming to a standard. And so when we take an action and we say, is the action ethical? I'm actually going to put the letter L right here. But when we ask, is an action ethical, a big part of what we're asking, and again, this is not just with regard to managerial accounting, but a big part of what we're asking is we're saying, does the action that we're taking, are we doing something that is generally accepted as being okay, as being a good choice, or are we doing something that, if our true intentions were known, would not conform to certain standards of what is right and wrong? So we're taking an action, and then we're saying, is it an ethical action? And we can answer that question by saying, okay, we've got some societal standards, particularly within business, and does our action match up to what we would consider good ethical business practices? Okay, so a little bit long-winded on that one, but you'll see about a zillion different definitions for ethics. So the next item is mission, and as we look through our answer choices, we've got this one right here, answer choice N, basic purpose toward which activities are directed. And we need to underline the term basic. I'm also going to write the letter N up here because a mission, and some of you may have, in some of your other business classes, you may have heard of something called a mission statement. And these are very, very brief. They're somewhat vague. So when we talk about a mission, businesses can have different missions. Sometimes we might have an environment where we're trying to produce the absolute highest quality product to a discerning customer. And other times we want to provide quote unquote quality products to customers who are looking to save money. So we can't get a lot of information from the mission, but we can describe a basic purpose of what we're trying to do. Controlling. This is a term that's going to come back to us whenever we get into the budgeting chapter. And it says, on choice O, it says comparing the budget with actual results. So a budget is an estimate of costs and related expenses, or it can be sales as well. But what did we think was going to happen? What did we project is going to happen? And then the act of comparing it to actual results and saying, okay, we did very, very well, or we did very, very poorly, or we did about what we expected. We call this controlling. All right. Number 4 is a goal. And what they've done here is they've given us an example of a goal. And so a goal is fairly specific. Now, a goal can be either long-term or short-term. We have one here in letter E, or answer choice E, that says increase your 2020 sales by 10% over year 2019 sales. Well, COVID had something to say about that, certainly. But this is a fairly specific item. It does, this we will actually have multiple goals. But they've been very brief here. We're focusing only on sales, and we've put a measurable percentage to this. So if we had sales of 1 million in 2019, well, a 10% increase means 1.1 million for 2020. Did we hit it? Did we fall short? Did we exceed it? But that's what we're talking about when we're talking about a goal. Cost drivers, very, very important term. So what is a cost driver? Factors that influence cost. Letter choice B. Okay, so you've probably heard the saying before, with regard to some action or some activity, this is driving up costs. So costs do not just appear out of nowhere. Some action has to be taken. And we're going to learn about many, many, many different types of costs over this course. But a cost driver, again, is any factor that will influence a cost. And so we might say, direct labor is a cost driver in terms of hours. Every hour that we incur in terms of direct labor, our costs go up. We're running machines. The cost of running, our total costs are going to go up when we are running the machines, and not go up so much as the machines are sitting idle. All right. Quality. Let's see here. And they've given us an example here in choice I. Says the degree to which a new ebook reader meets a buyer's expectations. So that doesn't mean that it's the greatest e-reader of all time, but if it was a discounted item that we bought for next to nothing, our expectation of quality is a little bit lower, and if it was a little bit pricier ebook reader, our expectations go up. So we can meet quality. Quality is not a term that you want to associate with being the best of the best. Quality is relative to the price paid for a good or service. All right. So the next term is balance sheet, and the balance sheet is certainly covered in Accounting 1 or financial accounting, no question about it. Look at answer choice C. It says reports a company's financial position We need to add a little something to this. At a point in time. Okay. So a balance sheet is all of the accounts that are on a balance sheet are what we call permanent accounts. And so that means they don't reset. You know, if we have cash of $1 million on December the 31st and nothing happens, we change to the next year, we still have $1 million in cash. So that's why we say we can look at a balance sheet at any point in time. We don't really look at a balance sheet. We can look at changes on a balance sheet and get some very, very limited information from, say, February to March, March to April. But mostly what we're looking to is determine, compare assets versus liabilities at a given point in time. Number 8, the income statement is a little bit different. Looking at choice F, and this is worded very well, an income statement shows the results of operations for a period of time. So income statement accounts, as you may or may not recall from your first accounting class, are temporary accounts. That doesn't mean that we get rid of sales and don't have anything to do with it at the end of the year or at the end of the period, but the sales total resets to 0. Okay? So a period of time, and again, this is something that we would cover in Accounting 1. Strategic cost management, I believe this was the first one. Making decisions concerning specific cost drivers. And so what they're alluding to here is determining, what types of drivers we want to track versus sometimes we will have some inconsequential cost drivers that maybe make up a little bit of our cost, but they're not a big enough deal to worry about. This is going to become a little bit clearer when we start talking about factory overhead and these types of things. There are a whole lot of decisions that will fall under the umbrella of strategic cost management. And this is usually when you see the term strategic, you can add a little bit more of a long-term flavor to what you're discussing. It's not necessarily a short-term consideration. So this is a strategic type item as far as the cost drivers, what is going to increase our costs as a company, not only today, but next year and probably in the years that follow that. Number 10 is financial accounting. And if we look at answer choice D, want to underline this term, external users. Accounting for external users. Accountants don't really ever look at income statements or balance sheets. These are documents that are for external parties, people who don't work at an entity. Accountants look at things like trial balances and so forth. And so the income statement, balance sheet, these are highly, highly summarized documents for people who are outside of the entity. And this can be investors, they can be regulatory agencies, any number of external users. Number 11 is activity cost driver. And if we look here, they've given us an example here in G, packing an order for shipment. Well, every time we pack an order, we incur a cost, and so that activity of packing the order drives cost. You see where they're going with that? And we can look at any number of items. This is, let's see here. This example that they provided here, packing an order for shipment, again, that we could come up with a gazillion of these things, right? Lots of different cost drivers. Number 12, structural cost driver. This is probably one of the terms that I'm not as interested in quite as much, but we go ahead and get through it. This is going to be answer choice H, and it says deciding to limit market focus to a region rather than an entire nation. So we are influencing our costs, or potentially even eliminating some costs based on a more strategic type decision. Again, that's number 12 is probably not as important, but on a multiple choice question, it would probably do you well to know the difference between numbers 11 and 12. Managerial accounting, number 13, very, very important. If we look at answer choice J, used internally to make decisions. So we can have certain financial statements like, a budgeted income statement, pro forma, which is kind of the same thing as a budgeted income statement, at least for our purposes. But managerial accounting is not based on external users' needs. It's based upon management needs. And what does management need to make the best decision? So therefore, an income statement is done on a monthly basis and a yearly basis, and we have all of these external financial reports that are due at a certain time, and they always cover the same amount of time, and that's not how it works with managerial accounting. We might decide that we want a variance report every week or every 2 weeks or every other day. So managerial accounting, much more flexible, much more based upon the demands and needs of internal parties. Okay, so resources are consumed by activities. This is answer choice A. We go out and we buy some copy paper. We consume the cash resource, cash asset, and we replace it with the copy paper, which is also an asset. It's usually going to be a supply unless we're reselling it. But then we're going to make some copies, and we're going to use up that resource as we conduct business. Okay? And then the last one, number 15, product differentiation. This is going to be, let's see here, answer choice M, reduces customer price sensitivity. So 15, let's see here now, that was M. And so what are we saying here when we say reduces customer price sensitivity? When we differentiate our product, what we're trying to do is create a situation where our product is different enough and our customers prefer our product in such a way that small changes in price, particularly whenever prices go up, will not deter our customer base from purchasing our products, and instead they run to someone else's. So this is not the same concept as like price elasticity or inelasticity. That generally deals with products such as gasoline, right? And if the price of gas goes up or down, people still largely have to purchase it. But what we're talking about here is, what if we had a gasoline product, a specific brand that was known to get more miles to the gallon? And so we look, and our brand is product A, and we're selling gas for $3 a gallon, and across the street someone else has gas for $2.98. Well, if it's known that our product is a little bit different and better, that 2 cent per gallon difference might not dissuade a customer from continuing to purchase our gas versus a competitor's product. All right, so that was a long-winded explanation of some important terms. I hope you learned something, and that's it for this video.